Hey everybody, Speed. Welcome to Stocks for Breakfast. Today we got a lot going on, and probably the most exciting thing is we are actually right near all-time highs. Now, here's the question: are we setting up? Are institutions setting us up for a big fake out? Are we going to barely take out that level and then kind of reverse in the other direction? We have a ton of stuff to cover this week, but I want to kind of put the pieces together so that you understand when to step on the gas and when we should be trading for cash flow. It's probably one of the biggest things that new traders or maybe even experienced traders never learn. And it really comes down to the fact that not all market conditions are the same. And when you learn to put those pieces of the puzzle together, it just becomes a completely different mosaic, and you have a lot more conviction and control over your ideas. So the parts of the market right now that are kind of interesting is bad news for jobs actually got interpreted as good news for the Fed to possibly cut interest rates. So that's why we're kind of sitting at just in front of all-time highs in the S&P 500 right now. But the people that actually push the market around are showing a lack of activity. So we're going to have to put the pieces together this week because there's new economic data coming out if you understand how to read the economic indicators. So basically what we're talking about was about not last Friday, the Friday before that was the jobs numbers. The non-farm payrolls came out, and non-farm payrolls are one of the big three things that the Federal Reserve considers to determine what they're going to do with interest rates. And obviously we know how that affects the stock market, right? Interest rates going down, stocks like that. Interest rates going up, don't like it as much, right? So the jobs number, which came in a little bit softer than expected, was actually perceived as bullish in the market. And that's actually why we got this bullish gap up over here. So if you can actually see the last 5 or 6 days of price action, this was actually the Friday morning when the jobs number came out. And you can see what kind of happened after that. And now you can actually see where we are and how close we are to all-time highs. Now, I'm a tape reader. I'm old school. I like to put things together, and I want to keep making sure that I give you these insights so that you can start to do the same. We can't move in a significant way in the stock market without institutional activity. There's really no other way to put it. And if you could kind of think about this, let's say you sold some jackets at your store, but you didn't sell that many. So you get excited the fact that you sold some, but you would have liked to have seen that register receipt to have a much bigger number. So that's where things get a little bit different, and that's actually where we need to pay attention. So if we kind of zoom on over and we head to the S&P 500 and the SPY, the SPY ETF, you can see, again, very similar. We're not that far off of the all-time highs. But then this picture down here is the thing that is just the most nagging thing, is the lighter volume on the S&P 500. That's really, really interesting. Now, I want to kind of work our way over into in the way that this was actually broken down by our options trading pro, for lack of a better way of putting it, John Napolitano. And I want to really bring this in because John was actually a options trading. He was head trader for a $42 billion hedge fund. So I just want to give some context to where this is coming, right? So one of the things I like to follow very closely is institutional activity. So I just want to give some context here, right? Volume is what moves the market, and institutions are the ones that create that volume. It's our job to shadow the institutions and basically piggyback what they do. One of the biggest challenges that people come into the market with is what I call the prediction paradox, is they believe mistakenly, it's absolutely a false belief in stock trading, that you need to predict where things are going. That is not the case. The stock market is probably infinitely more easy than you're probably making it right now. Our job, the way that we do things, and thank you, by the way, for being a part of our community here on YouTube, is we spend most of our time saying what is happening and how do I know if it's still valid and how do I know if it changed. See, the reason that's such a significant aspect of trading and a really different way of trading the stock market is that it takes us out of where do we think it's going as opposed to what is it doing now and what do I need to see that tells me it's still valid. It's so different. Again, it's very similar to driving a car. How do I know when to step on the gas versus how do I know when I'm in stop and go traffic and I need to change how I'm moving in that direction? That's a big part of trading, and it will decrease 90% of the stress you might have in the market right now when you simply say, I know what I'm looking for. Is it there? It's so much easier. It's such a relaxing way to approach the stock market. Now, what does that have to do with institutional activity? So I wanted to lay that groundwork to kind of give us why we would be expecting a big push in institutions, but the fact that we're not seeing it right now kind of makes me still have my risk meter just a little bit lower. However, we do have something big coming out this week, which is something we need to be aware of, which is one of the other ways that the Federal Reserve, Jerome Powell, measures what they're going to do with interest rates, meaning up or down, which is inflation. So 2 Fridays ago, we had the jobs number. That's one of the big three. The big three are GDP, gross domestic product, which is the economy. Number 2 is the jobs report, specifically non-farm payrolls. And number 3 is inflation. So we actually have inflation metrics coming out this week. And I'm going to show you what that is and how we're going to plan to trade around that. Okay. But before we do that, actually, I want to give you a roadmap, because every Saturday we have a swing trade session meeting with everybody in our community. And what we actually do is we map out how did the previous week unfold and how did we trade based on what was available. And then we map out the following week and we say, okay, where are the landmines? Where are the pockets of opportunity? And where can we get a little more aggressive? Where should we be a little bit more cautious on our swing trades? And this week we actually have that going on. So I'm going to point out both of those to you, how last week unfolded, how that applies into this week, and then what we could be looking at into Wednesday. So I'm going to kind of lay the groundwork here based on what John printed out for us, okay? So again, John was the head trader at a $42 billion hedge fund. So there's a lot of experience behind this, all right? So one of the things I like to follow very closely is institutional activity, which I mentioned before comprises most of the volume on major global exchanges. So that's obviously very important, right? Our job is to piggyback, find a spot in the direction of the institutions. We call that institutional shadowing, right? All right, based on the chart below, which is from Bloomberg, obviously, you can see that asset managers are trimming their long futures exposure, which is the white. You can actually see over here, it's actually decreasing compared to the market making new highs, compared to the actual move of the S&P 500 index. Now, I want to be clear. I want to keep bringing it back to this point. We're not in the job of predicting. You got to get away from the forecast fallacy, get away from the prediction paradox, and just live in what is happening and what do I need to see to tell me it should follow through. Okay, that's very important. Now, something else I want you to write down. And again, this is a posted pad moment, something we have all the time. We are looking for clues. We are not looking for answers. When you are looking for answers in the stock market, you tend to get stuck and locked on that opinion and say, that bull flag should definitely make me money. That breakout should definitely make me money. That's not the case. Our job is to set up high probability ideas near an optimal entry where then we could shift over and use our profit maximizer to hold on to those winning trades. Now, the part of the stock market that is kind of where you need to use the experience and use the tools and use the clues that we're talking about right now is which kind of profit maximizer should we be using right now based on the market conditions. Market conditions where everything is kind of on the same page and there's room to go and volume is fantastic, we would tend to use what we call our trend profit maximizer, which is a way that we hold on to winning trades longer, give stocks a little bit of breathing room where pullbacks are a part of the process, looking for the next bigger move. That's when everything looks great. And we just showed you volume is not perfect, right? We would have expected during those 5 days to the upside that volume would have been much better, and it wasn't, right? And you can actually see that down over here. Volume was pretty light. So when we're talking about what the market should be doing, we need to know how we're managing expectations. Sometimes you could step on the gas and everything looks great because there's nothing in front of you and everything looks rosy, right? But then there's other times where we're clear on the direction, but we're kind of stopping and going, stopping and going. That's kind of the market we're in right now. So we actually had a move to the upside, but there was no gas in the tank. That's what we're really talking about right now. So I'm going to shift that over into Wednesday right after I finish up with John's stuff, because I want to, and again, you want to screenshot some of this because this is really I wouldn't say it's advanced. It's just that John's really good at putting the pieces together. Remember, looking for clues. We're not looking for answers when we're in the stock market. All right. So let's kind of work our way through what John has in here. So again, establishing the fact that asset managers are trimming their long exposure. Okay, very important. This shows a lack of enthusiasm and participation among some of the largest players on Wall Street. Now, again, whether we look at it through this or whether we look at it through the chart, we're seeing the same thing. We're seeing that they did not participate on this rally. So basically, why did the market rally last week, and what do we need to pay attention to going forward? That's the next thing we're going to get to, because we're actually going to talk about economic indicators and how things ended up unfolding. And this right here is the big thing for us to pay attention to. So I want to be clear about what we're doing right now. And this is actually why we do these on Monday. We want to take a look at the week going forward to say, is it clear sailing, or is there kind of like black clouds in the future that I have to at least be aware of? And if I have a convertible, like when I used to have my Jeeps, do I need to have, the roof, the top with me when I'm driving, just in case it starts to rain? So that's kind of what we're leading up into Wednesday. Now, Wednesday's number is really important, and it comes out prior to the market opening, right? So let's take a look here. 8:30 in the morning, we have CPI numbers. Incredibly important. Now, PPI is Producer Price Index, which is coming out tomorrow morning, Tuesday morning, and that's important because that's what the people that are making things have to pay, and ultimately whether or not they're going to pass those costs on to us. But the CPI is one of the measures of inflation that the Federal Reserve uses. So we just talked about the big three. We talked about GDP, employment, which was the one 2 weeks ago that made it pop in a really big way, the market, because it was cooler than expected. Cooler than expected meant that now the possibility of the Fed lowering interest rates is now on the table. But now we have the second one, or the second of three, which is inflation. The CPI report is coming out, as we just said, Wednesday morning. So this is kind of one of those things that we really need to know that's coming up. Now, again, everything we talk about here is for educational purposes. It's up to you to make your final decision, right? It's my job. It's kind of my mission to help you make better decisions. So if you're in my community right now, which you are, you're in my YouTube family right now, we'd be talking about if we're carrying swing trades into Wednesday's economic data, which comes out before the market opens on Wednesday. Let's use Alan as an example. Let's say Alan was on my trading floor in New York City, and we're saying Alan's got multiple open positions. We've all been talking about it, be like, okay, do we want to carry those positions into the CPI report? Because of the significance of it, it's likely to have the market gap in one direction or the other. Now, the last big report, which was the jobs numbers, had the market gap to the upside because it was cooler, and the market gap to the upside because that now implies the Federal Reserve and Jerome Powell, the likelihood of them lowering interest rates sooner moved closer, okay? But now we have this next one, which is inflation. So there's actually two ways that the stock market measures inflation. CPI, the Consumer Price Index, has long been the main one that has been used to determine, can the Fed get inflation down to what they are calling their 2% number that they want. For some reason recently, the PCE number, personal consumption expenditures, is what people are calling now the preferred inflation gauge. Either way, whichever way you measure it, this is a big inflation number. If the number on Wednesday comes in lower, if the expectation is here and it comes in lower than that, that is going to be perceived as bullish for the market, because again, that's another reason, another clue. Again, don't predict, stay away from that prediction paradox. Another clue that interest rates are going to come down, which in the long run is good for everybody. That means that our mortgages are going to be cheaper, our credit cards are going to be cheaper, and obviously businesses that we're investing in are going to have better net profits because their borrowing costs are going to be going down, right? You see how this all kind of plays in together? So let's kind of get back into John, and then we're going to start to break down some of the ideas based on what's actually happening in the big picture here. So if we kind of continue to follow through with what John's thought process is here, then I'm going to give you my thought process from a little bit of a different angle. This is John giving it from the options trading perspective, all right? So seeing this sort of data and looking at the S&P chart itself, which we've done, we can assess that the higher probability outcome for the next couple of weeks is likely to be a choppy or range-bound environment. So that's number one. I'm going to get back to what that means for trading. Based on a few newer catalysts, we can expect things to behave in a range-bound fashion as well. So now we're going to take that and go into how I mapped out the same exact scenario without speaking to John, just so you could know that there's different ways of looking at this, right? So last week's roadmap of the S&P 500, the heat map actually looks pretty good. It became much better. So the language that we used in the market last week is market breadth improved. So now essentially what market breadth improved means is that more stocks met the criteria for bullish stacked order flow. And I'm going to show you how I run these scans for other people in our community. I basically do all of this work every night, and then I give our community the first stage of, okay, market's closed for about a half an hour now. Go in and dive into the research, and I kind of give them places to focus, which typically starts with sectors, okay? So if I walk you through and show you how we do that on the sector side, the first thing we do is we take a look at sector rotation, and we see how it's traded over the last 4 weeks. And we can see the last 3 weeks has been relatively good. So when we can start to see clues that things are improving, we start to raise our conviction level a little, and last week turned into a pretty decent week. Now, heading into this week, we start to pay attention to where should we start to focus heading into the week, and we actually have a pretty decent amount. And how crazy is it that utilities are actually at the top of the list? That's not usual. I don't know if Dennis is on the call with us this morning, but Dennis asked in the community why he wasn't in the scans. We don't usually scan for utilities to find ideas, but some of them have actually been trading pretty well recently. If you didn't happen to catch SEG, this is actually a really nice move coming out of earnings, all right? So I want to keep moving along. I want to get into the kind of compare what I looked at, right? So market breadth improved last week as more and more stocks show stacked bullish order flow. So if you're new to our YouTube channel, or you haven't gone through one of our accelerator programs, which you can learn about by clicking the link down in the description, stacked order flow is basically that volume that we were just talking about, which is institutional activity. So bullish stacked order flow shows us over time how long institutions have been involved in a sector, an industry group, or in a particular stock. The longer and more obvious order flow is stacked, which is institutional buying pressure, the more conviction we will have to say, well, they're still doing it. Let's hop on board with them. It's a lot, again, it's a lot easier than predicting. When we look for order flow that's stacked, so stacked order flow, we're essentially going out to the market and saying, where do institutions have their attention, and where is a good spot for us to piggyback them for that next move? That spot in our community, we call that the optimal entry. So there's really three things that I want you to learn from me, especially here today. There's order flow stacking, which is paying attention to how long institutions and which stocks, sectors, and groups are they buying. I'm going to show you what that looks like in just a second. Then after we find ideas, now this is something that's really important. And I'll actually use Goldman Sachs as an example. Let me pull that chart up and we'll go over here. So Goldman Sachs actually meets all of the criteria. It's in one of the strongest sectors, which we can take a look over here, which right now is financial. Financial is actually going up, and you can see over the last week or so, it's been pretty strong, right? However, Goldman Sachs is not near an optimal entry. So this is something that is really, really important. Because it's already rallied with the market last week, it is beyond a spot where risk reward makes sense for the next swing trade. So again, I want to walk you through this because it's kind of important. This is one of the things that a lot of traders miss is where they find stocks that meet criteria. They come up, they were in a scan, but they buy them too late. So when you have those three things down perfectly, which stocks to buy, which is stacked order flow, when to buy them, which is the optimal entry, and when to sell at the right time for the maximum profit, which we have as the profit maximizer. So now I want to kind of shift into which profit maximizer should we be using or thinking about right now, because we have two based on market conditions. A trend profit maximizer is what we use when all of the market conditions look great and all of that money, all the clues point to all that money is doing the same thing, right? We kind of had that during that massive 22-week rally in the market, which was over here. And you can see how dramatically things have changed. We haven't been going in the same direction. And as we've been pointing out, the heavier volume during this period over here was selling volume, which is very important to know, which is why we actually call the top in the market. Okay. So let's keep working our way through, right? Market breadth improved as we saw over here. So actually, you know what? I don't want to take this for granted because this is really, really important. What I'm walking you through right now is I am teaching you how to understand when to step on the gas, when to take quicker profits, and when to be in cash. I can't explain that strongly enough. The difference maker between you waking up every single day and saying, I know exactly what I'm looking at, and I know exactly what the risk is that's appropriate right now, and I know what kind of profit expectations I have based on what I'm looking at, right? That's my goal. My goal is to keep teaching you these things so that you have the ultimate control over how much you're risking, because that risk is justified because of the kind of profits that are available. Sometimes we scale down, sometimes we scale up, sometimes we take quicker profits, sometimes we hang on and we're like, don't touch that dial, nothing has changed, let's make a little bit more. Understanding how to adjust the same way you understand how to drive, step on the gas, slow down, that's what we do. And that's hopefully what I'm teaching you here in these videos, right? By the way, if you could do me a favor, if we're doing a good job and you kind of like these videos, do me a favor, hit that subscribe button. It would mean a lot to me. It also let me know that these are the kind of things that you enjoy watching. Okay, so let's head back and we'll take a look at this again. I want to keep moving through here, right? So positive sign that market breadth increased or improved, I should say, right? Because that means buyers came back after the non-farm payrolls report and supported the massive gap up. That's a really important point there. A big gap happened, and then they followed it up afterwards. It's really important, right? Light volume or not, stocks rallied. Mapping out this week, so now we're going into what's happening this week, what we're expecting to happen this week, what's on the table this week, right? We'll find out if the Fed gets another gift. Again, those big three economic indicators. The CPI data is released, which is the inflation numbers, okay? Jobs cooled off and lifted the pressure for the FOMC and the possibility of actually raising interest rates. So they're no longer, that possibility of them raising rates off the table now, okay? Very important. If Wednesday's inflation numbers come in lower than expected, the bulls will have reason to step on the gas and push stocks higher. So think about what we're doing right now. Before it happens, we are planning what we are going to do and what that means for expectations and follow through. So think about this. We are now teaching you how to step on the gas and when and what the conditions need to look like. Go back to what we said at the beginning of today's call. It is much easier to know and a lot less stressful to know what you're looking for and then say, is it there? And then know what kind of risk that means, as opposed to, hey man, where do you think that's going to be a month from now? Nobody knows. And if you doubt that for a second, start collecting headlines on all of your popular news sources and say, this guy says we're going up, the next page says we're going down, the next says we're going up, the next page says we're going down. You don't need to predict. You just need to pay attention and build as many clues as possible. One of the things that I talk about all the time, especially on our coaching calls, is once you understand how to read stacked order flow, you don't need new charts. You need to learn how to use them better. And I'm going to give you the perfect example. When you first started driving, when I first started driving, you were kind of like just on, like staying in the lane and just, hoping you stayed in that lane and you didn't notice anything else because you just wanted to be safe. It's the same thing with trading. After a while, you start to notice a lot more and you could put clues together to understand how to drive safely. That's what I'm teaching you how to do right now. Notice more. You don't need to necessarily know more once you understand what to look at. You need to learn how to use it better. And I promise you that. Okay? All right. So let's continue with how we're mapping out this week, and then we're going to get into some ideas. All right. So the markets got choppy and chaotic when there's uncertainty, which is what we had, right? Until that economic data came out. Two possibilities are on the table for this week. So again, mapping it out, right? If the uncertainty about rate cuts gets removed and the odds improve for it to happen sooner with a lower inflation report, smart traders will begin building positions with the intention of holding longer. Take a snapshot of that. This is the stuff that makes the difference between calling yourself a chart reader and calling yourself a trader. What we're talking about now is actually being a trader, because you're putting together the clues and it's telling you how you plan to trade. Now, this is where it gets fun, right? We would expect follow through if that happens. Lower than expected inflation numbers. If inflation comes in higher than expected, we're back into cash flow mode, which means that we shift to that different profit maximizer, which means when things slow down, instead of adding, we're going to be more likely to be booking profits. Okay. For me, that means lower initial risk and quicker profits. Now, here's where it kind of gets fun. So what you're saying is if it doesn't go up, it might go down, right? That's kind of what it sounds like, right? No. Is that hedging my outlook? No. It's being prepared for accepting the right kind of risk. And I'm going to highlight that. And I honestly, I hope that you take a screenshot of that, because it is critically important and it changes everything for you as a trader. Okay. Rookie traders falsely believe that all market conditions are the same. They never understand how and when to lose less, and never understand when the conditions are right to step on the gas and bring home bigger profits. Please do me a favor. Screenshot that right now, because it for the right person, that completely changes everything. Okay. Let's see. Hey, Tom, good morning. How's it going? Is sector rotation happening faster now than in years past? You know what? It's actually a good question. And let's kind of address why something like that might be happening, right? Let's address why things might seem like they're changing faster. Well, let's just think about it, right? I'm on YouTube right now. We're having a conversation about stuff that's going on. The information that happens throughout the world right now is happening at lightning speed. Stuff can happen across the world, and we can hear information about that in the blink of an eye, right? Information travels that much faster, which means that there is a mass of people now that have much better information faster to make different decisions. So are sectors changing quicker right now? Well, I think news and data and information is changing much quicker right now and available much quicker right now. And that's probably influencing why it feels like things are moving quicker. Let's also add into the fact that all those headlines are also being interpreted by algorithms and artificial intelligence that are not only first reacting off the headline, then they dig a little bit deeper into the actual data, and then that becomes a whole different, faster iteration of boom, they read the headline that one thing happens. If you doubt that for a second, pay attention to an earnings announcement or a Fed announcement, how the first announcement happens really fast, and then probably like 5 or 10 minutes later, a whole other move happens because now all that data gets absorbed. Are they happening faster? Yeah, 100%. There's all of the changes that are happening. When you think back to when I first started trading in April of 2000, which is now 24 years ago, there was a specialist on the floor of the New York Stock Exchange. 2 NASDAQ market makers had to call each other up and actually do transactions. Things took a lot longer, and the public really wasn't privy to as much information. Not that it was hidden from them. They just didn't have access to it because there was research that was dedicated to that firm, right? So things change. Again, this kind of validates the whole point of what we're talking about today. If you get caught up in that prediction paradox and think that you're going to read all that information and predict where it's going to be a month from now when it's changing that fast, boy, you're playing the hard game. It's so much easier to say, where is it and how do I know if it's still valid? What do I want to see next? So, Tom, that's actually a great question. Thank you for asking that. I really appreciate it. So let's continue to get on and talk about what that means for this week, right? This week is just one kind of scenario that we plan for, one kind of clues that we're looking for. The more of these plays that you put into your toolbox, the better you can predictably produce outsized gains. And isn't that really all we want in the market? We want consistency to the kind of gains. And the consistency we get comes from being able to put these clues together. The market, the earnings, and new technologies can fuel amazing trading opportunities, but when the economy and the Fed are in sync, it's a whole other level of conviction. And that's the point that we want to get across. These economic data, those big three, GDP, inflation, and jobs, those are the big ones because they all affect interest rates. Okay, let's keep it simple. All right, so I want to respect your time, and I want to move down into some of the ideas Earnings highlights, Home Depot is scheduled for tomorrow morning. Keep an eye on that as well. All right, so what about some ideas? What about sector rotation? Well, we actually just took a look at, you can clearly see here over the last 5 days and the trend over the last couple of weeks that we went from massively bearish and pretty bearish in technology, where things are now starting to work your way back to the other side. So take a snapshot of this, because this is really where, again, this is how I teach our community. Pay attention to these things first. When I am putting together this research for our community every night, I start out with the metrics of the market. I work my way over to sector rotation. I work my way over to sectors based on momentum over the last 5 days. And you can actually see, is this a great visual of how stacked order flow across sectors works? And then we work our way all the way over to sector stocks, and then work our way all the way over into stocks that have stacked order flow. When you have this process, it becomes so much easier. It's like, what am I looking for? Where is it happening? And then which stocks are near optimal entries? That's the whole process. It's about, it doesn't take a lot of time, because I'm literally giving you all the research. I'm kind of funneling it all down for you. And that's obviously what you're seeing here today. But I'm giving you the outline. I'm giving you the template. I'm giving you the process, which is start with the economy, work your way to the market, work your way into sectors, industries, and then find stocks at optimal entries. Is that a lot? Well, let me ask you something. Are you here to make a lot of money, or are you here to just kind of go back and forth and say that you're a trader? I'm telling you right now, if you go that extra mile, which could be an extra 5 minutes, an extra 10 minutes, an extra 15 minutes per day, however much time you have to do, that's where the money's made. That's where the conviction comes in. If you're going to say, I don't have enough time to do it, well, then you're not going to have enough time to make money either in a bigger way. I'm not saying it takes a lot of time. I just taught you all of this in 30 minutes. Once you have the process, and especially if I'm giving it to you, it doesn't take any more than 15 minutes a day. So ask yourself, if you have that excuse right now that I don't have enough time, can you find 15 minutes a day to make money? Can you find 15 minutes a day to say, I want to learn a little bit more about how to increase my conviction, to increase how much money I make? I'll bet you anything you can find 15 minutes a day. I would challenge you to do that. I have no doubt in my mind you can do that. And again, if you want to learn how to do this from me, you can click down in the description. You'll see what the accelerator is all about. Completely up to you. All right. So let's get into some of the ideas. I want to keep working our way through. And this is the part that you want to pay attention to here. Obviously, you can see how I'm tracking stacked order flow. Kind of cool to see the visualization here. Not only how many days in a row, but you can see if they're increasing or decreasing. So healthcare went to 0, neutral. So we're going neutral on that right now. So what does that mean? Now we got to start to pay attention to which ideas are following through and which ideas are setting up. So you can actually see Schwab in financials, which we just showed you is a little bit strong. So I'm paying attention to Schwab this week. And actually, it's a pretty solid new optimal entry. You can actually see from earnings how this trend is consistently pushing higher. Aflac, obviously at a triple breakout here, looking for this one to pop through this morning as well. Raytheon actually used to be Raytheon, now it's called RTX, did pop through as well. So you can start to see how I'm working my way from the sectors down to the individual stocks. And that's actually where the entire process starts from. So when you understand the process of looking at the economy and saying what's going on and how will the Fed do something, and I just taught you that today, then you kind of add that into, okay, how is the market reacting to that? Last week, the market reacted fantastic. We have more numbers coming out Wednesday morning. Think about what that means for open swing trades. Again, proper risk management keeps you in the game. That's all it means, right? Proper management, what's going on? What other clues can I add to this picture? So we go from the market, then we go into finding individual sectors. Where is money flowing? Where are we seeing the flow of institutional orders? And then we take a look and we find some ideas that are at what we call the optimal entry. And if we find some stocks at an optimal entry, we enter those trades with our first piece. Then we look for a spot to add, which, by the way that we teach it, our add share price is always calculated before the trade. It's kind of cool because there's no guessing on whether or not we should add. When it gets up to that price, we already plan to get in, adding more based on volatility, based on where we bought, and a whole bunch of other things. Then we move up to the initial profit target. The initial profit target is not limiting what we could make. It's simply the likely profit target for the initial risk. Once we hit that initial profit target, after we added shares, then we shift to profit maximizer and we try and make as much as we can on that trade. All of this, when done properly, is planned out before the trade even starts. That's where trading, all that stress comes out, and you actually start to feel like you're running a trading business because you're in charge of every action and you know what you need to see. And once you see it, you know exactly the right action to take. No stress because you're in charge. All right. Hope this helped you this week. We just kind of mapped out the entire week. A lot of stuff we did on a training perspective today. So if a lot of this stuff was new and educational to you, go back, watch the video one more time, take notes, leave comments below the video about anything we talked about here today. I would love to hear from you. I always get back to you as soon as I can. And if you want to learn about trading with me and all that kind of stuff, there's a link in the description as well to learn about the accelerator. All right. Have an awesome day, everybody. Let's make it an awesome week. Big economic data coming out on Wednesday morning before the market opens. You need to know that, especially if you're carrying swing trades. If those trades are right on the bubble of profitability, you're probably going to need to make a decision before that comes out. All right. Have a great day, everybody. Thank you for joining me. I'll speak to you soon.